Okay, so now we are going to start with the last trading of our fixed income, which is with respect to credit ratings. Now, if you recollect here, we have done in a bit in a small part in respect to what is credit rating. Credit rating is done by credit rating agencies, and they evaluate the credit risk of the borrower. So in fixed income market, whenever borrower wants to come up with an issue of bond, irrespective of whosoever that borrower is, right? They do have to do the credit rating. So how is the credit rating done? What are the aspects that we need to look into it? What are the features, or what are the important characteristics which are essential for the credit rating agencies? And how credit rating is done for risky bonds, sovereign bonds, and all. That's what we are going to learn in the process. But before we have an understanding of what credit rating agencies do, we need to understand what exactly credit risk is. So, by the way, the easiest way to understand credit risk is that the borrower will default, right? But if we go in more technical terms of understanding what is credit risk, it is the possibility, not actually the default. It is a possibility that the issuer will fail to make the payment either in full or even on time, right? So issuer will fail to make a scheduled payment in full on the due date and for losses incurred in the event of default, right? So first, credit risk is that the issuer will not pay on time or either will not be able to pay the full amount. That is credit risk. Everyone clear? Now, many people use credit risk and default risk interchangeably, which means they can use either credit risk or default risk. Are they both different? Practically not as such, but there is minor technical difference in between both. Let's understand that. Default risk is a narrower term because it addresses the likelihood, which is the probability or possibility of an event of default. So default risk will tell me whether there will be default or not. So the default risk is high, which means that the possibility or probability of default is high. Now, what do you mean by default again? That whenever the issuer has a liability on its head, the issuer won't be able to pay. Correct?
Yes.
Tell me one thing. Suppose you have, we'll take an example not from corporate, but let's take a typical residential mortgage or home loan example. If you do not, if you're not in the position to pay your home loan installments, let's say you have the next monthly installment and you're not able to pay. Okay. Now the possibility of you not paying is high. That is called default risk. So let's say your outstanding borrowing is of $50,000. Okay. And the home that you have as of now is actually worth more than that. Let's say it's worth $70,000. So tell me one thing. Today, if there is a possibility that I won't be able to pay, my default risk is high. Default risk, which is that I won't be able to pay on time. That risk is high. But the question is there a credit risk? And what exactly credit risk is? Credit risk here is that suppose if I default, what will the banks do? What will the banks do if I default? Tell me.
If
bank wait and watch.
No.
What will the banks do?
They might charge more interest.
I'm not able to pay the existing interest. Forget more interest. I don't have money to pay.
The thing which is collateral, they can take over that.
What is that collateral in a home loan? My home itself is the collateral, right?
Yes.
In the mortgage.
Yes.
So I did tell you that my outstanding was $50,000 and my value of my home is more than that. So let's say my value of home is $70,000. So just hypothetically, the bank will take over my asset, my collateral, right? And if the bank sells that, will the bank be able to recover 50,000 under this case?
Yes.
Easily, right?
Yes.
So now understand this. the bank does face the default risk that I will not be able to pay on time. But the bank does not face the credit risk. What is credit risk here? It's a much broader term. It just not considers the probability of default. It also considers the amount that I will lose or the bank will lose in case the default happens. Now tell me one thing here, if the bank takes over my asset, which is the collateral here, and the bank sells that, will the bank be able to recover its entire money? Yes. Then in that case, I may say there is default risk in this loan, but not credit risk. Why? Because credit risk is a broader term, as it considers both the probability of default and how much money will be lost in case default occurs. So it is possible that default risk on a collateral loan is high. That means my possibility of my defaulting is high. But there is also a possibility that the credit risk is low. Why would this both occur in an opposite way? Because I have probably given enough collateral to the bank, isn't it? Clear?
Yeah.
But on the contrary, suppose if there are default chances are high and the collateral that I have given has been substantially fallen in value. For example, let's say the collateral I have taken is a sports car whose value keeps depreciating very high on a very high scale, right? So my outstanding was, let's say, $70,000 and my value of my collateral is hardly $20,000. In this case, the banks do face the default risk if I'm not in the position to pay, but they also face the credit risk that in case if I give back them the collateral, they will not be able to recover their money. Are you getting the difference between default risk and credit risk?
Yes.
Everyone? So every default risk may not necessarily turn into credit risk. Are you getting this?
Yes.
Here. However, let me tell you, in the industry, when you talk to people, the default and the credit risk are generally same. But if you dig deep into it and if you want to get technically correct, then that's the difference between default risk and the credit risk. So concluding, default risk is the risk that the borrower will not be able to pay on time or not be able to pay the full amount. But the credit risk is that the lender will not be able to recover the outstanding which the borrower is unable to pay. That's credit risk. Clear, everyone? So,
yes.
So basically, there are some terms that we need to understand before we, dwell into the credit rating and all. Now, a bank has given has lent money to, let's say, thousands of borrowers. Now, all that money is due to be recovered by the bank in the future, right? So let's say bank has a portfolio of loans that banks have given around $100 million. Now, out of this $100 million, let's say, what is the amount that bank is having risk at? Let's say bank has collateral of 70%, correct? So the 30% is what I can say the bank can lose here. Am I correct? Right? So what is expected exposure? Expected means position which is at risk. I'll repeat, exposure is position which is at risk. So expected exposure is the amount of money that a bond investor, which is a lender, in a credit risky bond stands to lose at a point in time before any recovery is factored in. So let's say my exposure is around $100 million in loan. So that entire $100 million is what I'm exposed to the default risk. Clear, everyone? Any question? Guys, clear, right?
No. Yes. Yes.
So I'll repeat, what is expected exposure? Expected exposure is the amount which is due to me. The amount that I have lent, that can get default. That is my expected exposure. Now this exposure can keep changing on time over the period, right? Now the second term here is loss severity. Loss severity is the percentage of amount you will lose in case the bond has defaulted. So now let me give you all an example here. For example, let's say my loan portfolio, I'm a bank, I'm a lender. My loan portfolio is of $100 million, or hypothetically just say $100. Now, loss severity is the percentage of amount you will lose in case the bond is defaulted. Let's say the loss severity is 40%. So guys, how much money will I lose in case the bond is defaulted? Out of the exposure, 40% is what I will lose in case the bond defaults. So that 40% is my loss severity. So how much will I recover?
60%.
60%. Now 60% is called the recovery rate. Easy, correct?
Yes.
Now comes an important thing. Suppose if there is a default, we have understood loss severity is the percentage of amount that you will lose in case the default happens. Now that's in percentage. If I want to find that in amount terms, I will do what? I will take my expected exposure, multiply with loss severity. So $100 million is my exposure, multiply with 40%. I can say around $40 is the money that I will lose. This is called my loss given default. Everyone clear? How did I get loss given default? Expected exposure multiplied with
Loss
percentage I will lose.
percentage.
Exposure can be anything. It can be $20 million, $30 million into the percentage that you may lose is, let's say, 20%. So your expected exposure multiply with the loss severity. That's the dollar amount that you will lose. Clear? But what is the probability or possibility of loss? Not the percentage of loss. Probability of loss or probability of default. What is probability of default? It is the likelihood that the borrower will default. I'll repeat. A lot of students get confused between probability of default and percentage of amount that you will lose, which is loss severity. Both are different things. Probability of default will tell me the chance of default. And if the default happens, how much will I lose? That is loss severity. Clear? Everyone? So let's say if the probability of default of the borrower is 20%. So now tell me, how much will be the loss if the default happens? How much will be the loss if the default happens here? Everyone?
20%.
No. My question, listen to me carefully. How much is the loss if the default happens? The loss is $40. What is the probability of the default? 20%.
20%.
So the expected loss is nothing but the probability of default multiplied by the loss given default, which I can say in this case is $8. Is that clear, everyone? Now, it is very much similar to, like, I'll tell you a situation. We've done this situation a couple of times. Here, I will put up a situation. Suppose the entire exposure is, how much the exposure is? What is my exposure that I gave you all here? My exposure is $100 million, right?
100.
As a bank, my exposure is $100 million. Now, there are only two possibilities. Either the default will happen or not happen, correct? If the default happens, as per the loss severity, how much will I lose? If the default happens, I will lose $40, right? That's my loss severity. Am I correct?
Yes.
The loss severity I gave here is 40% I will lose. So guys, basically I will say 100 minus 40. 100 minus 40. That's what I will get from the portfolio. Or simply, if you just want to say the loss amount, here the loss will be $40. If I just put the loss amount, correct? But guys, if there is no default, what will be my loss? 0. Am I correct? If there is no default, there will be no loss. So loss severity means, guys, the percentage of amount that you will lose in case the default happens.
There is a happen.
Right?
Yes.
But that does not tell me the probability of loss. The probability of loss or the probability of default, let's say, is 20%. So the probability of no default is 80%. So what is the weighted average I can find here? The weighted average, I can say, expected return that we did in quants, right? Probability into returns. Here we can say expected loss. So my outcome will be 40 into 20, that is 8, correct? Or 80% into 0, which will be 0. So my expected loss from this transaction will be $8. As a lender, I may lose around $8. Clear?
Yes.
That's my expected loss. Now here, what did I multiply with what? My expected loss was a combination of two things. I multiplied two things. The loss given default, which is $40 here, and the probability of default, which is 20%. Clear, everyone? So $8 is the expected loss for the bank from this transaction. Correct, everyone? So I'll repeat again. Expected loss is a combination of two things. What? The probability of default.
Probability of the default by the multiply the loss given.
And what is the loss given default? It is out of the entire exposure. What is the loss severity? What is the percentage of money that you can lose? That is called loss given default. Is that clear, everyone?
Yes.
Now, why would this happen? Well, this can happen due to several reasons. This can happen due to the market condition, and this can also happen specifically due to the internal issues with the company, like credit migration. Now, what is credit migration? Credit migration, which means the credit risk is migrating. It means that the bond is facing more of a downgrade risk. Downgrade? Well, when credit rating agencies downgrade your bond, what happens? The risk of your bond
increases.
The risk of your bond increases, which means the default probability or the default chances are higher. And therefore, what will happen? The spreads or the yields will be higher, and the price of your bond will fall.
Oh.
Clear, right? Now, this is not the only risk that your bond will suffer. Your bond also suffers market liquidity risk. What is market liquidity risk, guys? In times of crisis, when you desperately need money, you will try to sell off your assets, which can be a bond or anything, and quickly recover something. But here, you are more in need of money. And when you immediately need money, what if you are not able to sell it? Or even if you are able to sell it, you may not get the desired price. That's called liquidity risk. Clear, everyone? So liquidity risk is the risk that the price at which investors actually transact may differ from the price in the market. So let's say my bond's value is $80, but when I'm trying to sell it because I desperately need money, I'm not able to get that entire $80. Why? But I may have to sell it at $70. That's what happens with assets like real estate or car, that when you need money and when you try to sell them, they have illiquidity in it. So you may not get the fair value that you are expecting. Clear? Therefore, when you invest in risky bonds, you know that not only they have the credit risk in them compared to a risk-free bond, but they also have liquidity risk instilled in them. Is that clear? So if you invest in a treasury bond, you won't find these risks. Which two risks you won't find?
Credit risk and liquidity risk.
And liquidity risk. Therefore, when you invest in a risky bond, you should get extra returns for these two risks. That extra return is what we call as premium. So the premium should be for the risk, the credit risk, and also for the liquidity. So liquidity premium is the compensation for the risk that may not be sufficient, that you may not have sufficient market liquidity when you're planning to buy or sell the bond, right? So compared to a risk-free asset, you will have extra returns expected from a risky asset due to the credit risk and also due to the liquidity risk. Is that clear, everyone? That extra return due to liquidity is what we call as liquidity premium. Clear? Now, there are two main issues that affect the liquidity or the liquidity risk. First is the size of the issue. So, you know what? US treasuries are issued in so huge quantum, the size of the bond is so high, and therefore the volume, buying and selling volume is too high. So if your bond is very thinly traded, it's very rarely traded. One of the biggest reason is that there's not enough liquidity. So the size of the issue matters a lot. What is the size of the issuer? Here, the size of the issuer is the amount of publicly traded debt an issuer has outstanding. Publicly traded debt means Let's say you have a bond of 100 million, right? And you have issued a million bonds of $100 each, but they are not listed. Well, if they're not listed, then there's no liquidity for me to exit, right? So publicly listing of bond is essential. If that happens, then the secondary market of the bond will be active, and that's where the liquidity will flow. Otherwise, it's difficult. Therefore, in order for you to have more liquidity in your bond, it's essential that you list the bond or have a platform where people can buy and sell. Clear? So the size of your issue basically means the size of the issuer here means how much of the bonds are available for publicly trading. Clear? Remember, like equities, bonds are very rarely issued in on the exchange to trade. So bonds have very thin secondary market. Am I clear with that?
Yes.
So first is the size of the issue, and second is the credit quality of the issuer. Well, lower credit quality will make sure that the trading is relatively less than the high quality bonds. So lower credit quality means high liquidity risk. Clear, everyone? So they both are in inverse relationship. So conclusion here, if in what case the liquidity risk be high, if the size of the issue is small and if the credit risk is low, in such cases the liquidity premium will be high. Am I clear, everyone? Right? Well, these are the important terms that we need to know before we go into credit risk. Now, let us quickly understand the overall structure of the bonds. Now, tell me one thing, that does a company issue only one bond over its entire life? No, it issues several bonds. So let's say I have issued the first bond of $10 million, right? And then I have issued another bond after 2 years of, let's say, $5 million, and then another bond after 3 years, and so on. In case if there is a default, will all the bondholders be paid in the same manner proportionately, or should there be a priority of claim? Well, there should be a priority of claim. So what is priority of claim? It means that which bonds will be paid first. It's how we rank the bondholders. So bonds issued by companies are ranked according to their priority of claims, and therefore not all bonds issued by one company face the same risk. So here, the ones which were issued the first, probably, they will have the lowest risk because in the case of default, they will be paid first. Are you getting me? So we know that compared to equity, bondholders are paid first. But within that bondholders, we have priority of ranking who will be paid first. Clear, everyone? Now, very naturally, the first priority goes to the secured bondholders. Now, what is secured and unsecured debt? We've covered that in the previous sessions, but what is quickly? Secured means, I've written here, they are backed by assets or collateral or guarantees. They have specific claim. They have priority of claims over the unsecured bondholders. Now, who are unsecured? Well, they do not have any backing of assets. They have a general claim on the assets. So let's say if I have 10 properties, and if I have one of the property which I've secured for the loan, so in case if I default, that property will be used to repay those bondholders. And the remaining property will be distributed amongst others, which are the unsecured ones. Clear? So if I'm a secured bondholder, I have a specific claim on the company's assets or cash flows, which an unsecured bondholder does not have. So definitely, which bond is more riskier here? The unsecured bond.
Unsecured.
Correct?
Yes.
Right. So now, because you have secured and unsecured bonds issued by the company over its lifetime, there is a ranking process. So the ranking process is called the priority of claims. Seniority ranking. The bond's priority of claims to the issuer's assets and cash flows is referred seniority. It basically means who will be paid first. Just as the borrowers can issue debt with many different maturity dates and coupons. So let's say a particular borrower like Microsoft, or a particular borrower like let me say a company like Reliance Industries in India, they have issued several of bonds, right? Which of the bonds will be paid? Because not all bonds will be of the same coupon or the same yield, because they may be issued at several time period. In fact, even governments don't issue bonds with the same yield and same maturity. They have several maturity bonds. So they can have many different rankings in terms of seniority. The ranking refers to priority of payment, with the most senior or highest ranking debt being paid first, and then the others will be paid. So any cash flow that the company generates, that cash flow will first be paid to the secured bonds and then the unsecured bonds. Within the secured bonds, you have senior secured and then you have just secured, or the second lien. Lien basically here means lien, some people call that, is a claim. So within the secured, you have senior and normal secured, or you can simply say secured bonds, correct? So of course the senior secured will be paid first, then the secured bonds will be paid first, and then goes to the unsecured. Within the unsecured also you have senior unsecured, you have senior subordinate, and then the junior subordinate. So here, of course, the first to be paid is going to be the secured, and within that secured, the first lien. So definitely, who will face the highest risk? The junior debt, correct? Therefore, they will also have the highest. They will also have the highest yield.
Yeah.
Correct. Now, let's say you and I, we are all investors in, let's say, senior unsecured. Here, I am also an investor. You are also an investor. We all are investor here. So, who will be paid first? Well, the first will be paid is the senior secured ones, right? After that, the secured bonds will be paid, and then comes the queue. In the queue, then comes the senior unsecured ones, right? Now let's say the senior unsecured, the amount left for the senior unsecured one is 100, and then there are 4 bondholders in this. We all 4. How much will we get? Well, does it work that within this, who came first will be paid first? No. In a particular category, all are treated equally. In a particular category, all are treated equally. So all of us have equal claim of, let's say, 25, 25, 25 each. Am I clear? So there is priority of rankings within the between the categories, but not within the category. Are you getting my point? Are you understanding it? I'll repeat. There is priority of claims. Can you repeat? There is priority of claims between the order of seniority, but not within a particular seniority. Clear?
Yes.
This is called pari passu. Pari passu is a Latin word which means equal footing. It means that all the creditors at a particular level are treated in one class. They are not treated separately. So in the event of bankruptcy, as I said, the seniority of claims can be taken into consideration, but within a particular ranking, all are treated in the same way. So my claim and all others' claims is same if there is a default in that particular ranking. Clear, everyone? Right?
Yes.
Everyone?
Practically,
this is by default in all the bonds. Yes.
Okay. Practically, is it followed in the same ranking? Like.
Okay, so that's where my next question comes. You can watch what is my next question. What you just said practically is what my next question is.
Okay. Why priority of claims does not work always?
So that's the question itself is your answer, but I'll elaborate that. So ideally, what should work? As per the indenture, as per the structure, as per the law, because this is a contract, right? Bond means a contract. As per the law, yes, the seniority of claim should follow. But what happens in reality? Let's say we all are senior unsecured ones. Okay, let's say that. Now I'll give you an example. First of all, let me also remind you that after these comes preferred shareholders and then comes common equity. Okay, so they are also the owners in the company. Am I correct?
Yes.
So let's say the company is now left with only $100 million to pay. The company is bankrupt. Let's assume that. How much money does it now have, or assets does the company have? Worth only $100 million. Okay. Now, the outstanding that is due to these guys, let's say this is $20 million. This is $20 million, this is $30 million, this is 10, this is 40, this is 30, and here these guys have $100 million. Let's assume that this is the money due to all of them. Now tell me technically, as per the system, who should be paid first and how much? Quickly.
Secure debt 20.
20, correct. Then another 20, so 40 is gone. Then 70.
Senior.
Then 8.
Unsecured.
And then the remaining of 20 goes to this. And all of this will get 0, right? The other.
Yes. Yes.
But if they get 0, they will go to the court. Once they go to the court, right, there is a legal process. The first thing that will happen once it goes to the court is that the distribution of this 100 million will be stalled. There will be a stay order for sure. Okay. So what will happen here? No one gets nothing till the settlement is reached. Clear? And
Yes.
you know, whether it's India, it's any other part of the world, US or Europe. Tell me one thing, what is the problem with court process globally? What is the process? What is the problem?
Takes time.
Takes time and money both, right? It's costly, right? So if you're an equity holder here, you will do all that you can to recover some money. You may probably drag the court case. You may stall the distribution of money to the debt holders and so on. So, and because equity holders have the voting power, debt holders do not have the voting power. Remember that, right? So here a lot of things can become very controversial. A lot of things can become very it can become ugly, and that's where the court process will probably take a lot of time. So the first thing that a judge would probably do is that he or she will put a stay order on the distribution of wealth, may appoint a third party to distribute, or may recommend the company to go for the bankruptcy process. And again, there can be court cases and all that for it. So eventually what will happen, there will be a settlement between all the lenders of the bank. And instead of all getting their fair due, what will the first and the second lien will have to do? They probably may have to let go some of their money so that even the equity shareholders get something. Clear? So in practice, it does not work in the manner that we expect. Ideally, in the event of default or reorganization, senior lenders have a claim before the junior ones or even the equity. However, a strict priority of claim is not always applied in practice. In theory, the priority of claim is absolute, which means it should go in the manner as it is. But in practice, it is not the case. In many cases, low priority debt holders even equity holders may get paid even if the senior debt holders are not paid in full. And that's because, as I said, of the court proceedings. This happens either by consent of the various parties or by the judge's order, and hence the absolute priority may not be strictly followed in the final plan. Are you getting me? Correct. So your question, does it answer your question?
Yes.
But I'll also share with you a case that I was tracking and what happened here. So Reliance Communication was facing severe crisis, and we all know that one of the India's richest person at time is now facing the bankruptcy issues. So there was a case between RCOM, the Reliance Communication, and Ericsson. Ericsson was the supplier of engineering products to Reliance, and the supplier of towers and so many other products probably related to the communication network. So Ericsson is a European company, and then they dragged Reliance Communication to the court to get their money back, right? So what Reliance Communication put up in the court that we cannot pay Ericsson because they are not the senior bondholders. Are you getting me? The argument that they gave in the court is interesting. They gave in the court this argument. Under the Insolvency and Bankruptcy Code, the financial lenders such as SBI State Bank of India was the bigger lender here to Reliance Communication. SBI have priority in getting repaid from the sale of assets, while operational creditors like Ericsson way down the list, means they are probably the subordinate
Unsecured.
ones, unsecured or
Subordinate.
subordinate ones, right? They are not the first lien. Clear?
Yes.
So there was a very big case out here. I don't want to go into the detail of case, but just want to tell you in brief that eventually Reliance Communication had to pay a big amount to Ericsson to, uh, get the founder secured from going to the jail. And then his brother Mukesh Ambani, the richest person in Asia, had to bail Reliance Communication, and then they paid the amount for bail and all, and then they paid to the Ericsson as well. But then SBI, State Bank of India went and said that, how can you pay the lower ones before paying us? So eventually RCOM had to pay to Ericsson before SBI. SBI may still not be paid, but Ericsson was paid. Why? Because the court ruled out that. So all in all, I'm trying to say here is that there is a possibility that the priority of claims may not be followed. Are you getting me?
Yes.
So of course, SBI said that, see, as per the contract, I should be paid first if they are paying to Ericsson. Why are you not paying me? So then, you know what? It all depends on the arguments in the court and probably the lawyers, the type of lawyers you hire. Eventually, the conclusion. I'm not going into the detail of what made the judge rule in favor of Ericsson, but yes, Ericsson is paid before the senior bondholders. So that is quite possible, and one of that case is this. Clear?
Yes.
Right. So basically, while I was studying, I used to get such questions. So I've put deliberately those questions and found out that, these are cases that has actually happened. Okay. So now we know what is credit risk. We know what is default risk. We know the capital structure. We know the priority of payment. We know that seniority ranking, right? All this is evaluated and put together in a score by credit rating agencies. They grade basically. Scoring is done for individuals, but for corporates, there is credit rating. What is credit rating? Credit ratings are used in wholesale market for bonds issued by corporations, governments, or perhaps any other, I can say any other, issuer. Entities, as well as for asset-backed securities. Asset-backed securities, securitized ones. Higher rated bonds, by the way, are more riskier or less riskier?
Less riskier.
They are less riskier. So higher rated bonds they trade at lower spreads, their yields are low, and their prices are high. And if the ratings are much better, they are virtually said to be risk-free if the ratings are best. The rating agencies provide a letter grade. Letter grade means, I will show you that they give the rating in alphabetical form, right? They also provide an outlook. So outlook, how will you get an outlook? Well, they will tell you whether the rating is expected to improve or the rating is expected to downgrade. There are three major rating agencies in the world. There are many, of course, but the three most prominent and the most famous are S&P, Standard & Poor, Fitch, and you have Moody's. Of that, generally the market follows S&P's credit rating. That's the most famous one. So in S&P, if you would see the most high category or high graded bonds are the ones which are almost risk-free. So AAA is said to be virtually a risk-free bond. There is no risk in it. Then you have AA, then you have single A, then you have triple B, then you have double B. But within that, if you notice, there is plus and minus. Plus indicates the outlook. It indicates that there is a chance of improvement, upgrade. Clear? And minus means there is a possibility of downgrade. And if there is nothing, it means there is stability, or that means there is no outlook as such. Is that clear? So tell me one thing. When you go from one point to another point, let's say if you are at double A, and if you are at the best category of double A, where exactly you are? Double A plus, am I correct?
Yes.
Then if the situation deteriorates, will you directly go to double A minus? No. You may go to double A without the sign, and then you may go for double A minus. After double A minus, if your situation deteriorates more, only then your credit rating changes to single A. This process where your credit rating goes, down, or credit rating changes from one point to another point, this process is called notching. What is it called as? Notching. Notching is the practice of lowering ratings by one or more levels, right? Notching accounts for loss given default. It means the chances of the amount that you will lose. First of all, if the notching goes down and down, the amount that you will lose will increase or decrease? Increase, correct? So there are several bonds issued by the issuer, and their credit rating may not always be stable or constant. They may keep on changing. So that process of downgrading or changing the level of your credit rating is called notching. Is that clear? Now here there is a red line out here. What is that red line for? That below that red line are which type of bonds? They are called non-investment grade bonds. And above that red line, which is triple B minus, they are called investment grade bonds or high yield bonds. Pension funds, insurance companies, sovereign wealth funds, endowments. I'll tell you what is endowments, foundations, etc. Banks. Most of them have a regulation where they are allowed to put maximum of their money in investment grade bonds, which means those bonds whose credit rating is come on,
triple A.
No,
about triple B minus.
Yes, about triple B minus. So triple B minus and better, that is all investment grade bonds. Most of them have to put their money here. So who are the world's biggest investors? Well, these guys, which I told you all, these institutional investors are the world's biggest investors. And let's say around 70 or 80% of their money is in these category of bonds. Are you getting my point? Correct? Now, what if you are at, let's say, triple B minus, and then if you have a downgrade, what will happen? Think quick. No,
the money, it will go into the non-investment grade.
No, but before it, no, you're wrong here. In fact, the money will be withdrawn from that particular company. It will not go into non-investment grade. The money will be pulled out from that particular bond issuer. Are you getting my point? So let me tell you that, let's say I'm one of the bond issuers, my credit rating is triple B minus. So will all these pension funds and insurance companies invest in me? Yes or no? If I'm triple B minus? Yes. Let's say all these institutional investors of the world have put $20 billion in my bond. But what if my credit rating suddenly gets downgraded from triple B minus to double B? Then what will these companies do? These insurance and other
take out the money out.
They will sell this bond. Just imagine the catastrophic disaster that it would have, right? Correct. So can I say the companies or the countries which have credit rating of triple B minus are probably on the edge, isn't it?
Yes.
Correct. So I will show you who has what credit rating in a while. But before that, I need to explain few more things. If you look at the C and D, they are perhaps those junk bonds. They are called junk bonds. Junk bonds are also called as high yield bonds, which means they are on the verge of default. The risk is almost equal to the risk of equity. Clear? Where you can probably lose everything. Am I correct?
Yes.
Right. So it is the credit rating agencies which decide what will be the credit rating, and they have a substantial impact not only on the issuer but on the economy. Bond issues require credit ratings by professional rating agencies to help investors make informed decisions. Well, if there is no credit rating, I will not get to know what is the credit history or what is the potential of the company to default and not. So therefore, credit rating gives me that indication quickly, correct? Credit rating agencies do the job of evaluating the credit risk of the borrower and accordingly give ratings to the issue as well as to the issuer. What is this? To the issue as well as to the issuer. Well, tell me, a company can issue several bonds. Will all the bonds have same priority of payment?
No.
So does all the bonds have same risk?
No.
No, and therefore multiple bonds issued by company may have different credit rating. For example, I've put here an issue by a company where the company has issued several bonds, senior secured, senior unsecured, and so many other subordinate bonds. And do all of them have same credit rating? No. Clear? Am I clear here?
Yes.
Right. So the issues credit rating, a company which issues several bonds, they may have several different credit ratings. So here the issue rating means corporate credit rating. It is also known as corporate credit ratings. The ratings are assigned to the various issues by a particular company, which can go from AAA to D, anything, correct? So if a company has issued thousands of bonds, hundreds of bonds or tens of bonds, then they all may have separate credit rating. Clear? So an issue credit rating means the credit rating of several issues by the company. Is that clear?
Like for it's an individual bond.
Sorry. What does it mean?
Like issue rating, like for a particular like individual bond, right?
Yes, so that's what, when a company issues, let's say 10 bonds, so all of those bonds may have several different credit ratings. They may not all have the same ratings because we know that not all of them will be paid in the same manner, correct? So the first, probably the secured ones will be paid first and then the unsecured ones. Therefore, they all have different credit ratings. So all the bonds issued by the companies may have different credit rating, correct? That's called issue rating.
Okay.
But what is the overall rating of the company? That's called issuer rating. So a particular issue can range from AAA to D, anything. But what is the rating of the company as a whole? That's called issuer credit rating. Are you getting me? The issuer credit rating is meant to address the obligor basically the borrower's overall credit worthiness. It is its ability and willingness both to make timely payments of interest and all. Now, one thing is which is very important. The issuer credit rating usually applies to senior unsecured debt. Senior unsecured debt. What does it mean? It means that let's say you have issued several bonds. The first one to be paid, we just understood here. The first one to be paid is the first one, come on, secured. And then within that, who will be paid first? Senior secured and then subordinate and so on. Senior secured ones and all. After that, unsecured will be paid, and within that unsecured, the senior unsecured will be paid first, right?
Yes.
So just hypothetically, let me give you all the credit rating here. Let me say the credit rating for all these bonds. Let's say a particular company has issued all this type of bonds. So I'll just put here the credit rating. Sorry, let me erase this. Let me put the credit rating of these bonds as AAA, then let's say AA, hypothetically, okay? The senior unsecured ones, I'll put the senior unsecured ones. Let me put their credit rating as BBB minus. I'm not putting the sign negative and positive. Let me just put BBB. And then you have BB and single B and C. These are the ratings of several bond issued by a particular company. Let's say the company is XYZ. Out of this, these are called issue ratings. Now, what is the rating of senior unsecured? The senior unsecured bond rating of this company is BBB, right? Now, that is also called as the overall rating of the company. So if someone tells me what is the rating of this company XYZ, I will say the rating of this company is
Triple B.
triple B. It is equal to the senior unsecured ones. Am I correct? So the issuer rating is always equal to the senior unsecured debt. Now, when I say the issuer credit rating, it is called the corporate family rating, the family overall company rating. Clear? And a particular credit rating of a corporate, that's called issue rating. The entire family rating is called issuer rating.
Issuer rating.
It tells you the overall credit worthiness of the company or the issuer. Clear, everyone? Right?
Yes.
So now that gives me an indication to describe you all that the credit rating, the upgrade or the downgrade is very, very essential. So when a particular issuer's credit rating changes, that's what we call as credit migration. Credit migration is a change in the credit rating. We just discussed that. It reflects the change in the bond's credit risk. So let's say when a situation happens that the bond's credit rating changes, we know that its yield and price will also be impacted. So its spread changes, let's say its spread increases or widens up, its yields increase and the prices will go down. So the bond portfolio managers or people who invest in bonds want to consistently see what is the credit rating. So bond portfolio managers often want to evaluate the performance of the bond in the event of credit migration. So if there is a credit downgrade, then what will happen to the bond portfolio? How much will be the loss? That is what we call as credit migration or credit downgrade risk. Is that clear?
Yes.
So now let me show you all what is the credit rating of companies as of today. I think we had discussed that somewhere. I think I had showed, I don't remember it. Let me see if we can possibly get. Yeah, I think we had discussed that right here.
Yes.
India has a credit rating of triple B
Triple B
minus. So we are on that edge. If our credit rating falls below this, the institutional investors, the global institutional investors will pull out all the money. Correct? Right? So for us, the credit rating is very, very crucial. You all didn't remind me that I've already covered all this thing. Okay. So does it mean that the credit rating agencies are God? No, of course not. First of all, they lag. I'll show you one of the risk factors. What are the risk factors here? Their rating tends to lag the market. So they tell us the information late after things have happened. Most of the times, technically, as per the theory, I will say no, most of the times they are accurate. But practically, they tell us they are like that Indian police. They come to the crime scene after the crime has happened. Okay. So they probably tell us about the company's default when we have already read that in the newspapers. So they lag, their credit ratings lag. Okay. Also, the credit ratings are not constant. For example, when the company issued the bonds at that time, its credit rating was better, but now it may have deteriorated. So they may not upgrade it. And even if they do, as I said, they lag. Third, credit rating agencies are like auditors. They can make mistake. And plus, why do I say they are like auditors? They do make mistake, but they do not have any responsibility or onus on them if they go wrong. There's no one to catch them, hold that why did you went wrong. Are you getting me? So there are several professions where if they go wrong, there is nothing for them to lose. Like investment analysts, if their strategies go wrong, probably they don't lose as much as the clients lose. Auditors, if they go wrong, the company may become bankrupt, but they probably don't lose as much as, because they can say that we did the independent analysis, true and fair, and they can use those fancy words, right? Lawyers, if they lose a case, probably they don't lose an amount. I understand there is a credibility loss, and I'm not downgrading any profession here. It's even like us professors, we don't lose anything if a student fails, apart from the credit risk that we lose, right? So every profession has that way of escaping, I should say, that we don't suffer as much as immediately as much as the customers suffer. So none of us is saved from the part that we may not make mistakes. We all make mistakes. But here, if credit rating agencies make mistake, people are going to rely on them and put billions of dollars, right? And if that turns out to be wrong, trust me, the entire market collapses. Why? Because what are the types of mistakes? Well, they may not accurately capture all the risk. It's difficult to capture all the risk. Well, you cannot capture many of the company's micro level risks or many of the economy's macroeconomic risk or systematic risk. That is difficult to capture. So rating agencies, as I said, they are not God. They probably cannot capture everything, right? Therefore, it is very risky to rely on credit rating agencies. And we've seen them in the 2007 subprime crisis. Well, just before the Lehman Brothers collapse, they had AAA credit rating. Their bonds had AAA credit rating. Can you believe that? Just couple of days before the bonds or the company collapsed. Can you believe that? Based on AAA, so many investors must have put in Lehman Brothers, right? And just within a couple of days, the company collapsed. That has happened not only in 2007-8, but even in our country, we've seen that case with DHFL, Yes Bank, ILFS, and so many. All these companies had superb credit rating before they got default. Only when the news came out in the public that there are some things severely wrong with the company, after that, the credit rating agencies in India, like CRISIL and all, CRISIL is a subsidiary of S&P, by the way. After that, they probably published and they downgraded it. Are you getting me? So auditors or credit rating agencies, they unfortunately tell us about the story once the story ends. Clear? So it's very difficult to rely on them. They have a chance of being incorrect. And if you completely rely on them, you may lose a lot of amount. So it is better for investors to perform their own credit analysis also and derive some conclusions before they completely rely on the credit rating agencies. Is that clear, everyone?
Yes.
That's all about the credit rating agencies. Now, what does the credit rating agencies do? See, whether you rely on them or not, it's their job on a day-to-day basis to do the credit evaluation. So what does this credit rating agencies look out for, or what is their process of evaluating credit? They generally use 4 C's. Some call 5 C's and all, but 4 C's is a minimum requirement that all of the credit rating agencies or credit analysts, I can say, they use these fundamental principles in order to conclude that what is the credit risk. Some use 4 C's, some use 5 C's. So that's just one and the same thing. Some may separate one of the C's that I will discuss you into 2 parts and all. So what are these 4 C's that a credit rating agencies use or a credit analyst use? The first is capacity. Capacity refers to the borrower's ability to pay. Now, how can I judge the ability? Well, I can judge the ability by seeing what? The financial strength of the company, right? So it refers to borrower's ability to repay the debt. Analysis of capacity is similar to like that of equity. Well, in equity analysis, we see what is the potential of the company to pay back me the dividends, right? Or give me price appreciation. That's where we calculate FCFF and all, free cash flows, correct? In the same way, in case of bonds, we are going to look out for the capacity. We are going to look out for what is the potential of the company. Now that capacity depends on 3 levels of assessment. First, the industry structure. Industry structure, do you recollect the Porter's 5 forces?
Yes.
It means that the industry that the company is into, does it have high competition or less competition? Does it have a dominance or does it have severe competition where it cannot dictate the price? That's what we do. First, we see the industry structure. Then within the industry, we see the fundamentals of the industry. What are the cyclical issues with the industry? What are the growth prospects? What are the profitabilities in the industry? How many players are there in the industry and so on? So first we see the structure of the industry, and then we see the factors important or the fundamentals of the industry. Finally, after that, we do the company fundamentals. We go into deep into the company fundamentals, and the primary process of that begins with analyzing financial statements and calculating ratios. Apart from that, you also look at the management history, their history of the past, whether they have defaulted or not, their operating history, and so on. So that is all. Probably I can say capacity is nothing but the potential, the financial strength or potential of the company to pay back. Clear, everyone? That is the first C, capacity. Everyone clear with me on this? Right? The second is collateral. Collateral means the security that you provide for the loan, right? That shows your credit worthiness. For example, if you are giving less collateral, that means the risk is high. So what is the collateral that you're giving? What is the quality of that collateral? How much is the collateral? That is important. For example, intangible assets like patents. Patents and goodwill are intangible assets, right? Tell me one thing which has more value, more tangible value, I should say, even though they are intangible, which has more real value, patents or goodwill?
Patents.
Patents, right? Because you can trade them off, you can sell them off separately. But goodwill is not separatable from the business, right? And goodwills are tested for impairment, and their values can go substantially down. So in terms of intangible, patents, if you have patents, better credit quality or better collateral compared to goodwill. Depreciation, how does depreciation affect? Well, if your asset is very highly depreciated, if the value of the asset goes substantially down, then there is a higher chance of loss, correct? So then in that case, I would say the collateral is of a low quality. For example, tell me, if I give you a collateral of my home or my car, what is a better? Both are of same value. Let's say both are of same value right now. Both are, let's say, of $50,000. What is more comfortable for you as a collateral? A house or a car?
House.
Why? Because you know that car depreciates more and faster than a house, right? So lower depreciation, better outcome. Equity market capitalization. Yes. Well, a stock that trades below the book value. Oh, book value means the value as per the balance sheet. Is it possible for the companies to trade its value below the book value? Yes, it is possible. So stock that trades below book value may indicate that the company's assets are of high quality or low quality. The company's assets are of low quality, which means that what is going to happen? Which means that there's huge potential loss expected. Correct? This happens in the case of banks. Most of the banks have price to book value ratio, which is either 1, nearby 1, and in many cases that is below 1. So do not get attracted by lower price to book value ratio and tell me that, wow, its price to book value is so low, let's invest into it. Well, banks have a huge portfolio of potential or non-performing assets, right? These are assets which may default in the future. They have not defaulted yet, but may default in the future. Are you getting me? So in such cases, the price to book value ratio will be low. The market cap to the net worth of the company will be low, and therefore in such cases, the risk of the company is very high. Clear? So these are few of the issues that you should consider while evaluating the collateral. Also, some companies have high human and intellectual capital, but unfortunately, it is difficult to value. So, but a company may have intellectual property that can function as a collateral. So even if I have, let's say, 100, one of the world's best algo analysts or traders with me, now that of course has a very high, intangible value, or I can say that's very high intellectual value, but that is not good from a collateral point of view, because they may all run away from the company if the company collapses. So, having a more, visible, a value visible collateral is considered a better choice. Clear, everyone? So 2C's cleared, everyone? Capacity and collateral, right?
Yes.
What is the third C? Covenants. What is covenants, by the way? You remember covenants? Covenants are the conditions or the clauses put by the dash on the dash. Borrower on lender or lender on borrower?
Borrower to lender.
These are conditions put by the lender on the borrower. Okay. Why would a borrower put conditions? Borrower does not have the right.
Sorry, yeah, lender on the borrower. Yeah.
Lender, right? So that is covenants. Now there are two types of covenants we've already discussed: affirmative and negative covenants. Affirmative covenants tells you what you should do, and negative covenants means what you should not do, the restriction list. Now the problem here is that if the covenants are too restrictive, then the issuer will find it difficult to operate. So covenants that are overly restrictive of an issuer's operating activities may reduce the issuer's ability to repay, like for example, prohibiting sale of assets. Well, if you cannot sell the asset, you may not be able to generate the cash and you may not be able to repay the bond or repay any liabilities. On the other hand, covenants, see, first of all, covenants should not be more restrictive, but does that mean that the covenant should be completely free? No. Then the bond issuer will do whatever the bond issuer wants. So covenants are there for protection of the bondholders, but the protection should not be like too restrictive. Are you getting me? So covenants create a legally binding contractual framework for repayment of debt obligation, which reduces the uncertainty for the debt holders. So, well, covenants are that double-edged sword. Why? Because they protect you from default as a bondholder. But if they are more stricter, then that will hinder the operations of the borrower. Are you getting me? Correct. Therefore, you have to do a careful analysis of covenants and see whether that helps the company or not. So careful credit analysis should include the assessment whether the covenants protect the investors without causing any problem to the borrower's operations. Clear, everyone? So 3 C's we've done till now. Which one? Capacity, which tells you the financial strength. Then collateral, which is about the asset which you've provided as a security, right? And the third is covenants, which are the conditions or clauses that you put in the contract. Correct? And the fourth that the credit rating agencies see is the character of the company. What do you mean by character? Remember one thing, that you hire a person in your company. You decide to marry someone in your life, or you decide to give money to someone. All of these things, when you do these things, you see both. And let me be practical, both. By both, I mean the potential of the person and the willingness of the person, the ability and the willingness both, which we say in India as the nature and the potential of the person, right? The character of the person, the attitude of the person, and the financial strength. That's what we look both when we decide to go ahead with someone, right? Whether that's a company, that's a life company, or whether that's investments. So we all know that, let's say a company like NMC or Kingfisher Airlines. Do you think that these companies do not have the potential to pay? Do you think that these companies do not have the potential or did not have the potential to pay back?
No.
They did have the potential to pay back, right? They have billions of dollars of assets still abroad, the founders. But they do not have the willingness to pay. Clear? So as a credit analyst, for me, both are important. It's not only the potential, it's also the willingness of the company to pay. The companies may be very financially, very strong, but what if the company had the strategy to deliberately delay its payment, to use its political might at times, or to use its financial might to, go for refinancing and delay unnecessary payments or delay the payment to vendors? Well, that shows me the character of the company. So the character assessment, it's basically the commitment of the company to repay the loan. So what do I need to check? I need to check the strategy of the management. What is the management strategy? Does the management have a proper strategy to repay the debt, or it's random? Track record. I will check in the history whether the companies have paid things on time or they have delayed, right? have they gone for any bankruptcy process or restructuring or refinancing process? I need to check that. Well, even in individual cases, when a credit card companies give you credit card, they do check your credit score or your past default history, whether you paid things on time or not, right? In fact, they also look out whether you paid the utility bills on time or not. They also check that. Accounting policies and tax strategies. Well, if the company has, has a history of hiding issues, not paying proper taxes, and many cases against the companies which are in the court, or many times the auditors issuing a red flag against the company. These are all, even the company's financial strength may be good now, but they are all a concern for me as a credit analyst, right? Recently, I read an article where the America's richest, like Elon Musk or Jeff Bezos or even Warren Buffett, they have virtually paid no taxes. We've seen in the history during the election campaign, Donald Trump being always accused of evading taxes, right? Well, you can fight legally and say that, I've done everything right, but that of course, gives me a signal that the willingness of the borrower here is at question mark, correct? Any case of fraud or legal or regulatory problems with the company, definitely they are red flag for me. And priority of treatment to the previous bondholders, that's very essential. So what if in the past you've argued with the bondholders, you've not paid them on time, but you've paid equity dividend, or you've issued bonds to finance acquisitions rather than issuing equity so that your stake does not get diluted. All these are signs that the companies are working against the bondholders or probably favoring the equity holders, because the equity holders are the promoters, right? All this will give me a good overview of the character of the company. Is that clear, everyone? Right?
Yes.
So clear with all the 4 parts: capacity, collateral, covenants, and the character. Correct. These are the 4 C's that any particular credit analyst should be looking at. Now, one of that was capacity, and capacity means ratio analysis. Now, I will discuss quickly here the ratio analysis, but let me tell you, when we were doing FRA some 45-50 years back, in that we did financial ratios, and in that we did credit analysis, right? So your factors like EBITDA, FFO, free cash flow, before and after dividends, and EBITDA margin, and so on. We have already discussed this in the past, but I'm sure we must have forgotten a lot of them. So I'll reiterate here. So profitability ratios. See here, what is going to be the focus of an analyst? The entire focus will be whether the company will be able to repay the interest and principal or not. That's going to be the major focus, right? So first, I will focus on the profitability ratios. We have EBITDA. EBITDA is earnings before interest, tax, depreciation, and amortization. So what do I do here? I add back the non-cash here. It's very much like operating cash flow. Why? Because operating profit, EBIT, operating profit, right? Earnings before interest and tax. And then you add depreciation and amortization. So it's almost like an operating cash flow. What is FFO? What is FFO? We did that in the past. I'll repeat again. FFO is very much similar to operating cash flow only, but except working capital. So just see, net income plus non-cash charges like depreciation and all, plus deferred taxes. But here I am not taking into consideration the changes in the investments, correct? So FFO is very much similar to like CFO, but without the working capital changes, correct? Free cash flow before and after dividends. What is free cash flow? Cash flow after reinvestment. That's called free cash flow. So you recollect that free cash flow to the firm, free cash flow to the equity holders. Do you remember that?
Yes.
So free cash flow to the firm is net income plus non-cash minus reinvestment. Reinvestment goes into working capital and fixed capital. Now, there are 2 types of free cash flow that we'll be focusing on. One, which is before giving equity dividends. Now, before giving equity dividend, whatever is the amount left that you can distribute as dividends, correct? And after paying up to the dividends, that is free cash flow after dividends, the amount which is left, that is what you can use for 2 things. Paying off the principal of the debt, correct? Or reinvesting that back into the company for growth. Am I correct?
Yes.
So free cash flow before dividends can be used for dividend payment. After dividends can be used to retire your debt, that is principal repayment, or reinvest back in the company for growth. Correct? All of these ratios, naturally, higher the ratio, better it is. Clear? Then I focus to the leverage ratios. Leverage ratio, they are all connected to the debt. So here you have debt to capital and debt to EBITDA. Well, debt to capital means out of the total capital, let's say of $100, how much is the proportion which comes from debt? Should it be more or less from the credit analysis? The higher the ratio, better it is, right?
No.
No, the lower the ratio, better it is.
Better it is.
So debt to capital shows me the proportion of debt in the entire capital. Debt to EBITDA basically tells me that how much of my debt is compared to the operating profit or the operating cash flow, right? So let's say if the total debt is $100 and if the EBITDA is, let's say, $20, so I can say at least it will take me 5 times more EBITDA to recover my entire debt. So here again, the amount of debt should be low compared to your, the amount of debt should be not too high compared to your EBITDA. So this ratio, the lower the ratio, better it is. Clear? FFO to debt. Now this is interesting because now in the numerator you have FFO, denominator you have debt. So what is FFO? Fund flow from operations, right? This is the cash flow. This is basically the cash flow without the working capital. So cash flow divided by the debt. So it is the cash available to pay the debt. Now, in this case, I will say higher the ratio, better it is. Why? Because I want more cash flow to repay my debt, right? In the same way, I can say free cash flow after dividends to the debt, which means whatever is the amount remaining, which I can pay for the debt. If there is more and more free cash flow remaining after the payment of dividend, that money I can use to retire the debt. So higher these two ratios, higher the ratio, better it is compared to the other leverage ratios. Am I clear, everyone?
Yes.
Finally, you have coverage ratios. It means whether you have sufficient profits or cash flow to cover your interest expense. So you have EBITDA coverage ratio and you have EBIT coverage ratio. Both of them will tell you whether you are able to repay the interest and by how many times. So let's say you're in EBITDA coverage, in the numerator you have EBITDA, in EBIT you have just EBIT. Both of the ratio, higher the ratio, better it is, because it tells you in number of times you have operating cash flow or profit to repay your interest. Well, this ratio should be as high as possible so that you can comfortably pay the interest. Clear, everyone?
Yes.
So just you can take a quick look and accordingly you can apply it. Now, we all know credit spread. Can you tell me what is spread? We've discussed that. What is a spread?
It is a difference between the benchmark yield and the corporate yield.
And the corporate yield. Definitely the corporate yield should be more, correct? And the corporate yield compared to the benchmark, which is a risk-free security, should be at least equal to risk-free security plus the risk premium. What is the risk premium? It is that extra return for the risk that the corporate bond may have. What are the risks that the corporate bond may have? Well, it can have a risk which is related to inflation, maturity, higher risk, liquidity premium, that's what we know, and the default risk, which is the credit spread. So a particular investment in a bond, in a corporate bond, should have returns at least equal to the risk-free rate. Now, actually a risk-free bond, which is like a US Treasury bond, is also called as nominal risk-free. And nominal risk-free is a combination of real risk-free and expected inflation. You remember that? Nominal risk-free. So compared to the benchmark, what are the additional risk premiums that I expect from a corporate bond? Well, if the maturity is high, I want maturity premium. Because treasuries are more traded, my bond will be relatively less traded. So I need liquidity premium. And the third is that treasuries are risk-free, my bond is not risk-free. So there should be the credit risk, which in this case I am putting as credit spread. Clear, everyone? Credit spread is just the difference between risk-free and risky bond only due to the credit risk. Is that clear?
Yes.
So a particular YTM on a corporate bond is a combination of various things. It's a combination of nominal risk-free rate, which is a combination of risk-free rate plus inflation, and then several types of risk premium depending on what are the additional risks involved in the bond, which can be due to maturity, liquidity, or credit. Now, here my focus will be more on the credit risk. Credit risk is the risk that the company will not pay me on time or default, right? So what are the factors which can affect the credit risk? Well, the credit cycle. What if there is less credit available in the market? What if the interest rates are very high? In such a case, the company may not be able to arrange funds for its operations or for future payment. And therefore, that the company can, if the company is into bad credit cycle, there is higher chances of default. Therefore, the spreads will increase. If the economic condition has been deteriorating, the company will not have enough profit, like in the cases of pandemic, where the companies were facing severe financial crisis. That's where the spreads will increase.
Please.
Internally, even if the economy is doing good, what if the company's financial performance is bad? What if the company is struggling with its operations and its business? That's where the financial performance of the company matters. And if that is not up to the mark, then the credit spread will increase. 4, what is overall broker dealers' willingness to provide liquidity in the market? You know what? Compared to equity in bond market, the dealers or the brokers play a prominent role. Why? They are the ones who supply liquidity into the system. Remember, bond is not an equity type of a market. It's a code driven or it's a dealers market. Now, dealers market, which means here it's not the buyer and seller will decide the price, it's the dealer. They provide liquidity to the system because bonds are not that frequently traded. So if the brokers and dealers are not willing to participate or put in their capital in the bond, then there will not be enough liquidity. So that can affect the spreads of the bond, right? And the overall demand and supply of the bond, generally the government bonds have a higher demand, or the high credit rating bonds have more demand. But if your bonds demand is less because maybe the investors don't know your company or they don't rely your credit worthiness, in such a case, the bonds spread will be higher. Clear? Now, for me, technically, I look 2 factors when I evaluate the credit risk. That is, I look at the sensitivities, which is modified duration and convexity. You know that for smaller changes, I can rely on modified duration. But if the change is higher, if the spread is too high, if there's a sensitivity with the spread is too high, in such a case, it's not only the duration, but I may also add convexity into the picture. Clear?
Yes.
So in the same formula of change in the price of bond, due to the change in due to the sensitivities like modified duration and convexity, here instead of YTM, now what do we apply? Change in spread. Clear? So hardly there are questions in this particular topic. One of that question I put here, which we already covered in the previous sessions, but still. So 6-year corporate bond with A- credit rating is upgraded to A+. Guys, when the credit rating is upgraded, the spread should increase or decrease?
Decrease.
So if the spreads decrease, the price should
Increase.
The price should increase. So out of the 3 choices, you definitely know the answer has to be the positive one or the negative one. They have shown us the choices for price impact. Positive one. So definitely I know the answer is either A or C. Correct?
Yes. Yes.
Right? But definitely not B, because the spreads have decreased because the credit rating has been upgraded. Clear? If it was downgraded, I probably did not even look at the, I did not even do the calculation. I can just simply pick up the, negative.
B.
So this has shrunk its credit spread by 17 basis points. Its modified duration is 5.1. So I will say 5.1, and shrunk means the spreads have gone down by how much? 17 basis point, which is 0.17%. Correct? And its convexity is 82.5 multiplied with 0.5. Sorry. Multiplied with what do I do? 0.17 raised to 2. Clear? So that gives me an answer of 1.2. Just check it if it's correct. Sorry, I think it's wrong. What's this?
0.17% basis
Okay,
points.
my mistake. Sorry, I forgot to put 0.17 percentage. Okay, so here I get the answer of 0.0088, or I can write 0.88 percentage. 0 instead of O, sorry, 0.88 percentage would be my change in the price, positive change in the price. Are you getting it, everyone? Correct? Right, just calculate it and let me know. It's 0.17 percentage because the change is 17 basis, which is 0.0017. Clear?
Yes. Yes.
So my answer here in this case is A. I've deliberately kept the difference very minor, but trust me, in exam you won't have such minor difference. You may probably have better difference here. Clear, everyone? So this is all got to do with credit spread. Now, although we've covered most of this part in the previous reading also. So tell me one thing, if given a choice, which bonds will you want to invest? Which type of bond? What type of credit rating bonds would you want to invest?
High credit rating.
High credit rating. But remember, if you invest in high credit rating bonds, you will relatively get lower
Lower yield.
yields. So definitely there are investors who invest in high yield bonds, which are not investment grade bonds. They are non-investment grade bonds. They are bonds below triple B and minus. Why? Because they know that they are taking the risk, but they're going to give them higher yields or higher returns. But here, when you invest in such bonds, you just can't rely on the credit rating. You know that there is some problem. So there is an additional due diligence or additional research or analysis required from your end. For example, why we first need to understand why is their credit rating low, or why are they riskier? Probably they are using very high debt. They do not have enough operating history. Maybe it's a startup. So the startups have initially negative cash flows, right? They are very sensitive to business cycles. What if they are in the business of infrastructure or something? So they are very vulnerable to the business movement. Low confidence in the management. Maybe the management is inexperienced and all, right? Unclear competitive advantage. Most of the startups, they do not right now have a clear advantage unless and until they become unicorns. Large off balance sheet liabilities, which may be in terms of contingent liabilities, or you can have many of the companies do have some legal cases against them, right? Or many of their investments are in derivatives and all. Industry is in decline. In such cases, definitely all this can be the reasons that the investment or the credit rating of the company is relatively low, and therefore they are riskier. Correct? As an analyst here, I will have a special focus on few considerations here. I'll have greater focus on the liquidity and the cash flow. Remember that these are high credit rating, high yielding bonds. So even if I see their prices as, let's say, $70, I may not be able to get that $70 when I sell them, because there are going to be less buyers for them. Correct? So there's going to be a liquidity issue with such bonds. I need to go with detailed financial projections, so that I need to know whether the bond or the company will default from this point or whether it will recover. My best bet is that the company will recover from this point.
Recover. Yes.
So detailed understanding of all the financial statements and the debt structure and corporate structure is essential when I do due diligence for these companies. So it's not that people don't invest in high yield bonds, they do, but their analysis is in much detail. Clear, everyone? Now, there are several ratios which are beyond the ones which we did in credit analysis, that we specially look when we invest in high yield bonds. Now, who will be paid first? We know that the secured ones are paid first, correct?
Yes.
And the secured, after that, the unsecured ones are paid, correct? Now, within that secured ones, the senior secured are paid first, and then the then the subordinates are paid. Even within the unsecured ones, the senior unsecured are paid first, then the subordinate and junior bonds. So we know the priority of claims, right? So the total company's leverage consists of various types of bonds. Okay. What is the difference between total and net leverage? So the difference between total and net leverage is the adjustment of cash. Let's say the company has $100 million of debt, but also the company has $20 million of cash. So I will say the total debt of the company is $100 million, but the net debt is only 80 because I will subtract cash available with the company, correct? Which I can use as payment for debt, right? So that's the difference between total and net debt. Remember that. So I've kept up an example here, data of KGB Limited and its debt structure. It has a rating of BBB minus. So we have been given cash, total debt, EBITDA, interest expense, secured debt, senior unsecured debt, and subordinate. Tell me who will be paid first?
Secured debt.
After that, senior unsecured or subordinate bonds?
Senior unsecured.
And then subordinate.
Subordinate bonds.
So given the above information, calculate the following. They have asked me to calculate secured debt leverage. Secured debt leverage. What is secured debt leverage? It is the secured debt amount, which is 2297 divided by the EBITDA. How much is the EBITDA with the company here? 522.
522.
So the secured debt leverage is 4.40. Easy. You have to compare that with the EBITDA. Senior unsecured debt leverage. Now this is interesting. So tell me one thing, when I'm looking for the risk for senior unsecured, the amount that has to be paid to the senior unsecured is 1030, but that will only be paid after the secured debts.
Secured debt.
So here, very interesting, senior unsecured debt leverage does not only mean their amount, but it also means all the previous amount before them. So I will take 2297, which is the secured one, plus 1030 divided by 522. Are you getting why? Correct?
Yes. Yes.
Because you need to understand it's not mathematics. Here you're trying to understand what is the risk involved with the senior unsecured. And they will be paid after the secured ones. So in the same way, it's basically cumulative. So when I say total leverage, it will include all the debt divided by the EBITDA. So what is all the debt here? All the debt, the total of the debt, 2297, 1030, and 463.
263.
If you add all of them, you should get 3790. Am I correct? Just check it. 3790. Correct? 2297 plus 1030 plus 463. Correct?
Yes.
So that's called the total leverage. Take the total debt and divide by the EBITDA. But net leverage means I will take 3790 and subtract the cash component. How much is the cash component? I have 587. 587. Definitely this is going to be relatively less if you have more cash. So this would be 6.14. Clear? All of these ratios are in times. The leverage is always in times. So I will say 4.40 times is the secured debt leverage. And the senior secured is definitely more because that includes the secured ones. Clear? And the total one will be the highest. Is that clear, everyone? Correct? Any questions, anyone?
Yeah.
Now, in this type of bonds, high yielding bonds, what is going to be comfort for an investor? Where would the investor see that, yes, due to this, I get more information and I'm comfortable that, I may not lose enough money. The investor need to check the covenants, the conditions under which I may lose money or I may get money. So covenant analysis is very, very critical in which type of, it's critical generally also, but in high yield bonds, it's more critical. For example, one of the covenant, there can be change of control put. Change of control, which means that if the new owners come into the company due to a merger or an acquisition, then the bondholders may have a right to sell or put the bond, correct, at par. So Is this a condition comfortable for the bondholder or not comfortable?
It is comfortable.
It is comfortable. So that I should check whether this option is there or not. Correct? Restricted payments. Yes. Now this is interesting. Covenant protect lenders by limiting the amount of cash that may be paid to the equity holders. Equity holders? Okay. So many companies have covenants that the equity holders will be paid dividend or any amount only after the bondholders are paid. And the bond money cannot be used to repay the equity. Those are the covenants which will provide me more comfortable. They should be there. Limitations on liens. Now this is interesting. Now tell me that, now let's think about it and tell me, I've issued a senior secured bond and then I've issued an unsecured bond, right? But after that, I issue another secured bond. Is that fair? It's not fair,
No.
right? Why? Because then the guys who have come in late, they will be paid before me. That's very unfair. So most of the covenants have restrictions that they have limitations on additional secured debt. You can't issue more and more secured debt, which is senior to the existing debt. Why? Because then they will be paid before me, which is not fair. It's like jumping the queue, which is not allowed, right? Then you have restricted versus unrestricted subsidiaries. Now this is interesting. Now in many cases, there are restrictions for a company to use its money for its subsidiary, which means, let's say I have tens of subsidiaries. If one of my subsidiaries is struggling with money, I may fund it by my another subsidiary. Correct? Now this is something that if you are the investor in that subsidiary, it will give you a protection. But if you are investing in the parent company, then this is an additional burden to you. So you need to check whether there is a restriction between transfer of subsidiaries or not. So restricted subsidiaries cash flows and assets can be used to service debt of the parent holding company. Correct? And hence benefits the credit holders of the parent company, but it's at a loss to the subsidiary, isn't it? Correct? So it can happen vice versa. If you are a bondholder in the parent company, so subsidiaries money can be used to pay you back. Good or bad for you? Well, that's good for you.
Good.
But look it from the subsidiaries point of view. You may have to take burden of the other companies also. So that's relatively riskier for you. Clear? So you need to check that into the covenants also. Also, finally, you need to check that there are some restrictive covenants, some special covenants for organizations like banks. Bank covenants can be more restrictive than a typical corporate bond covenant and may include the maintenance covenants such as leverage tests. Banks are very tightly regulated, so banks have to maintain a lot of ratios. For example, there is a ratio called capital adequacy ratio. They have to maintain some minimum capital against the risky assets that they have. So let's say the bank has given loans, which is the risky portfolio of $100 million. So what is the minimum capital that the bank should have? That keeps on increasing with different Basel norms. If you have heard Basel 1, Basel 2, Basel 3. So that demands more and more capital from the bank in case the bank is having more risky assets in their portfolio. So the banks generally have more restrictive covenants than a typical corporate bond. Correct? So tell me, overall, investing in high yield bond is more riskier than a typical risk-free bond or a less yield bond, correct? Therefore, their analysis is more like equity analysis. You should treat them as like equities only, because they are not completely risk-free and they are not as high riskier as equity, but they are somewhere between both, I can say. So you need to have, we call that having a hybrid approach. Why? Equity like approach to high yield analysis needed, as high yield bonds are sometimes thought as hybrid securities because they are not as high as quality bonds as AAA bonds, right? Because they are somewhere between the high quality bonds and the riskier bonds. So that's where their analysis should include many factors like equity, because they do have chances of default. Clear? So they are not completely equities, but they are not completely bonds which are relatively risk-free. Clear, everyone? right?
Yes.
This is the analysis that we need to do with respect to high yield bonds. Finally, we need to do some research and analysis for sovereign and municipal bonds. Municipal bonds and sovereign bonds. Sovereign bonds are issued by
Government.
by the governments, right? So I need to check into accounts 5 key areas with respect to the macroeconomy. First, institutional assessment. It means that how the country's institutions, especially the banking and financial sector, how does it work? Is it corrupt? Is the policy making, the people in the policy making, are they corrupt, or are they family members, or are they independent professionals? That's what I need to check, right? Second, I need to check the economic aspect of the country, the growth trends, the GDP, the inflation, and so many other factors of the economy, right? Third, external factors, which includes countries' foreign reserves. For example, as of now, India has, I remember a couple of years back, we had foreign exchange reserves of $400 billion. As of now, we have $600 billion of forex reserves. That shows the financial strength that we have, right? So more foreign exchange reserves, more access to currency and foreign loans, that shows the external potential of the company. Fiscal assessment. What is fiscal, by the way? It's all about government spending and revenue. Well, if the government is spending more than its collection of taxes, that's its revenue, it's what we call as fiscal deficit. So government has to be very much disciplined with respect to its fiscal deficit. Clear? If the fiscal deficit is increasing, if the government is spending more and more instead of the collecting taxes, that means the governments will do more borrowings in the future. And more borrowings means the risk will increase. Clear? And therefore, I also constantly check the debt to GDP ratio. Debt to GDP ratio tells me the amount of debt compared to the GDP. It's like what we just did with leverage ratio. We see the amount of leverage as compared to the EBITDA. That's what debt to GDP ratio is. GDP is the, you can say, EBITDA of the economy. It's the total amount of goods sold during an accounting year or a financial year. Clear, everyone? Correct? So basically, I will see these factors and then I will conclude whether the economy is at a better position or not. So fiscal assessment, you have to check the fiscal deficit, and then you have to also check at the debt to GDP ratio. Apart from that, analysts also look as the monetary assessment, which is we basically look at fiscal and monetary policy. Monetary policy is all about managing money, which is done by the central bank. So how does the central bank do its job? Whether the central bank is infusing liquidity into the system or sucking out liquidity from the system, how much control the central banks can have, how much independence the central banks can have. Have you noticed that in democratic countries like India, especially, the central bank and the finance ministry, the Department of Finance, which is by the government department, they both are always at loggerheads. They both always fight. Correct? Because the head of the central bank probably wants to increase the interest rates. The government tells reduce the interest rate. So there's always a conflict. Good, bad?
Good.
It's a good sign. It's a sign that the central bank in a particular country has the potential to overpower the government. See, the government does influence, but as of now in our economy, the central bank has more power than the governments when it comes to monetary management. So that's a healthy sign. Having an independent monetary management system increases the credibility of the economy. So all these macroeconomic and broader factors I need to check when I'm investing in the sovereign debt. Clear? Compared to this, the non-sovereign or the municipal debt is the debt issued by a city, a county, or a state, right? So when let's say the city of Montreal or the state of California, when they issue bonds, then that's what we call as municipal bonds. And within that municipal bond, these type of bonds issued by the local government. Remember, the local governments do have the taxing authority. You have city taxes and state taxes, right? You have the central government taxes, but you also have the state taxes, correct? So when a local government issues bonds, they are called as GO, general obligation bonds. They are one of the part of municipal debts. They are very much like a sovereign bond. But but not completely sovereign bond. But they are almost risk-free because the states also do not default, and if they do, then the center will bail them out. Correct? The federal government will bail them out. Am I correct? So geo bonds are general obligation bonds issued by the state or city or county, and they are very much same like a sovereign bond. But then there are revenue obligation bonds. Revenue obligation bonds are issued, let's say, by the water authority, the dam, the one who is constructing the dam or the road, the National Highway Authority of India, for example, issues bonds. These are the bonds which will be repaid from the cash flows or the operational cash flows from the particular project. So their analysis should be very much like a corporate bond. The only part here is that they are backed by the government indirectly. So they are not risky as the corporate bonds, but the analysis should be like a corporate bond, because then the cash flows are dependent on the cash that the project will give, right? So you cannot rely that, oh, the government will give me money. No, you need to see whether the government will of course give you the money in case of there is an issue, but you need to check about the yields, whether I will get more yields by investing in these bonds. So you need to check whether the road that has been constructed, will that generate enough cash flow, will that generate enough toll taxes and all. So that's what you need to check when you are investing in revenue obligation bonds. Clear? Revenue bonds often have high credit risk than geo bonds, naturally, right? Why? Because a city or a county can increase the taxes and get money, but a company which creates a national highway cannot do that, right? Because the project is the sole source of funds to service the debt for revenue obligation bonds. Clear, everyone?
Yes.
Right? Yes. So we've covered several aspects of credit risk, and that's where we end with this topic of understanding the credit, the fundamentals of credit risk. Is that clear, everyone? So that's the end of our particular topic. Anyone has any doubts or anything, please let me know.
Are the high yield bonds that much publicly traded?
See, overall bonds are less traded, and if you recollect, bonds are very less traded in the secondary market, which I mean the exchange. Most of the bonds are traded in the OTC.
Yes.
High yield bonds are also traded in OTC, but the government, there's no volume as much as the government bonds. The government bonds, treasury bonds, has the maximum volume. So that's where the maximum volume goes. All other bonds are very less traded relatively. So high yield bonds have liquidity issues because of lack of trading. Okay. Yes. Correct. That's it. That's the end of all this thing. And yeah, that's probably where the fixed income also finishes.